Okay, thank you for having me at the conference. So far, I enjoyed every paper. Last presentation of the session, so probably I'll try to be quick. You already have seen through many other papers before, and you already know about Bird from Asaf's papers and others. This paper is joined with Wendy Du, my PhD student. She's focused on NLP and finance. We have 3 papers on NLP and finance, including BERT and the variants. One of them is looking at emerging technologies, how we can figure out emerging technologies from earnings conference calls. One is whether firms talk the walk or walk the talk on environmental and social issues. Again, we use a similar kind of technology. And third, right now we are looking at inflation in this paper. And Agam is an incoming PhD student in NLP and to work with me because of my interest. We are taking PhD students in NLP and ML also. And Minhan Zhang is a former student of mine who's at Babson. Wendy deserves a lot of the credit. She's going to be the market next year for those who are interested in looking at candidates. Okay, so this paper is inflation. I don't need to motivate it much. Inflation is a 4-decade high in the US and across many other countries, and probably inflation and the monetary policy response to that, that's driving many of the stock markets and asset markets around the world. And probably, again, I had some discussions with others yesterday and today, probably are going to, we haven't seen the end of it, right? I think as the inflation, rental rates and others, everything gets indexed, there might be more to come, or at least not back to 2% inflation that we are more used to in the US. So inflation and asset prices, again, long literature, so we don't need to go into that. But what we do here is looking at the heterogeneity. The firm. Hopefully, I don't need to restart. Okay. So what we are going to focus on this is the heterogeneity in firm level exposure to inflation. And we want to capture that because different firms have different exposures to inflation and different ways of reacting to the inflationary pressures or the cost, and we want to look at that. The broad idea here is, in this particular paper, is to look at a text-based measure. I'll go into more details on how exactly we do that. Develop a text-based measure of inflation exposure at the firm level and also time varying. So over time during the sample period, and then we want to look at the implication to stock prices. We'll do some event studies around earnings calls and also some slightly longer term studies. So what's the challenge in terms of measuring inflation directly from, let's say, we can use a keyword-based approach. Again, I don't need to, based on the previous paper, I don't need to go into details of that, or we can use some other embeddings, simple approaches. But they probably are not going to cover everything because first is in terms of each firm, even though we can observe the cost of goods sold and some wages for some firms, and some other costs, we don't have a complete picture of the firm's inflationary pressures. The costs, I think what it's going to matter for the cost, but also for the output prices. So directly we can't get the data, and firms use many different kind of inputs, many different kind of outputs, different production functions, so it's not that easy to get that. If we do based on just a keywords, that probably is also not going to be sufficient. I'll explain why in a minute. What we do is we use a deep learning approach. Again, we use BERT, Rabata, we use a couple of 2-3 variants of that. And then we identify discussion of price changes, both input price and output prices at the sentence level in the earnings conference calls. We think it's a good way of looking at it because managers, this is the top of the mind many a time, and managers have a good idea of how the cost pressures are building up. Analysts might ask questions about these things. And they also have information about how much of the pricing power they have. Are they able to pass on some of these costs again to the end users? So we think of the earnings calls is a good setting where the managers might talk about both the cost pressures they're facing, how much they're able to pass, and how the output prices are evolving. So we look at analysis call transcripts, as I mentioned, the sentence level. I'll go to why we do at the sentence level rather than the entire transcript. We break the transcript into sentence, and each sentence we code it. The inflation exposure we measure as the number of sentences where they talk about input prices going up minus the number of sentences where they talk about input prices going down. And then we normalize it by the number of sentences in the transcript. So, the main findings in some ways it is not that surprising. The first one we think of as more of a validation. When we look at with the PPI and CPI, there is a strong correlation with them. I will show some graphs later, but around 0.77 correlation with that. That gives us some confidence that what we are capturing is about inflation exposure of the firm. In the cross section, what we find is there is a negative market reaction to the earnings calls. The firms that are more exposed to inflation, this is significantly larger negative stock market reaction on the day the information comes out in the earnings calls. And pricing, if they have more of pricing power, or they talk about more of pricing power, they can pass on this cost to the consumers, then some of them it is mitigated. Inflation exposure predicts higher cost of goods. We again think of as a validation. What we show is when we look at cost of goods sold, wages and labor costs, what we can get from the computer data, we find that there is a strong link between our textual measure and the future goods sold. So, that again think of validation. We do one more analysis, which is looking at the CPI release days. Again, the market has a consensus estimate of what the CPI is, and then sometimes they might be surprised. What we do is we look at the surprises. We look at the firm response, those firms that are exposed to high inflation, and we look at the response of these firms on those days. We find there's a more negative response because the inflation came out larger than what they anticipated. And we also look at salient days where the inflation is greater than 2%. Again, for a long time in the US, it's more around 2%. So, we look at those days when those times when the inflation measure exceeded 2%, for example, the oil shocks and other times in 2012 and 14 when it happened. This is an example of how the CEO Sanderson firms, how they discussed in earnings calls, what's happening with their earnings. Again, we just highlighted some of these things. I won't go into all that. But if you look at, for example, feed grain costs that are significantly higher. Let's say input, if I remember right, Sanderson Farms is chicken and other kind of meat. So, they're talking about the input prices, how they've gone up, and why they might have gone up is partly because of the increase in the crude oil prices and the transportation, and they also paid more for corn and soybean, which is again an input that they feed to the chicken, and then they have some other information on how they're adjusted to that. The broad idea is either the managers might talk about it because it's an important issue for the firm, or it might be that the analysts might ask them questions because they think it's a salient information which they want to get more insights, more color from the CEOs. What we do is we take in this kind of information, but again we don't want to use just a dictionary based approach. As you can clearly see, depending on the type of industry, depending on the type of the firm, even depending on the CEO, there might be different ways of looking at this information. So, just a simple keyword based approach might not capture that because there's too many variations and we don't want to do that, the dictionary based method. Again, we can use a simple rule based method, that is, for example, there's a price change and within 2 words of it, there's some other sentence up or down. Again, I have used those kind of things in the past. They work sometimes, they are better than simple dictionary, but they still might not be sufficient to capture. That is why we go to more of the transformer based models that we are going to look at. So, what we do is here we use three, I will talk about again as Asaf mentioned before, like from 2017 there is a sea change in terms of NLP literature. Transformers attention is all that you need. That's the most famous paper that came in, 35,000 plus citations, and then the transformers, and then came in BERT. Then there's refinements of BERT, like Roberta, Distilbert. There's a whole bunch of FinBERT, which is fine-tuned on finance language. There's many variations of that, and we use some of them. And the idea is that at each sentence we break down the sentences, and each sentence we label. It's not our contribution. I don't think of so much as the NLP technique, because in some ways it has become standard. It's open source, you can use Hugging Face, you can use other means of accessing that. So, it's not so much on that, but with all the NLP tasks, many a time the labeled data is the big challenge. There's not as much clean labeled data. So, what we do is we actually label the data and we train the pre-trained model again, we fine tune it on those things. That is the one which took a long time, and I think that is partly one contribution of the paper. So, at the sentence level, what we do is whether the sentence, as we ask 3 questions. One, whether the sentence has price change related information, that is one. Second, whether it is up or down,
and third, whether it's input prices or output prices. So we want to get 3 sets of information which we can use in the fine tuning task later. But we can't, again, as you know, like this around 100,000 plus earnings calls that we look at, and if you look at the sentences that runs into millions of sentences, we can't go and label all those sentences for our fine tuning task. So what we do is, first, again, we start with a simple keyword based approach, but what we look at is a set of keywords. Again, all these are reasonable, from wages to cost, pressure, inflation, deflation, etc. And we look at each industry, we look at various transcripts and select those transcripts that have the highest number of them. The idea is we are going to read those things. That's why we already generate around 28,000 sentences. So we don't want to generate it into hundreds of thousands or millions of sentences. That's why we start with a keyword based approach to just select those transcripts that we want to do. And the second thing is, we look at 2021 first quarter. In some ways, we wanted to make our labeling task a bit easier. We didn't want to go to times when there might not be much inflation related discussion. That means we'll be reading through many sentences and won't be generating any cases where there's inflation related discussion. That's why we start in 2021 when they might be talking more about it. I don't think there's any look ahead bias in this kind of thing, because we're just trying to get a dictionary. So I don't think that's as much of an issue here. So as I mentioned, once we have this human labeling, this is the one which took a long time, because we go in those things around 28,000 plus sentences, 28,000 sentences, and each one, the 3 of my co-authors, they read through like each one separately, and then when there's some kind of disagreement, they discussed, and then they came out with a 1-0 to label it. 1, whether this sentence has information or not, price information. 2, are they talking about prices going up or down? And finally, are they discussing input or output related prices? Again, there's a lot of again, judgment that needed to be made in some ways, because it's not so straightforward. That's why 3 of them did separately and then collaborated to make sure that they agree on these things. So when we look at, for example, over 28,000 sentences, what we find is around 5,000 of them have the target words. That's the one which we have, but they also read the no target words. The idea is that we don't want to miss those sentences which have the information, but our target words didn't capture. So around 4.5%, 4.12% with no target words, but they still have discussion, which they're able to label. But most of the 95% of the ones with target words, they have this information and which they're able to code. But many of those with target words didn't have any price change. So again, that's 12%. So that's why a simple target based approach is not going to work as well. But this is the first step in terms of generating a labeled data set, which we can use as the downstream task, which we can apply our models. And this in general in the NLP, many a time, this is the tough one, because it takes more time to generate the labeled data. If you have labeled data, you can do these models very easily. Okay. So what we do is we look at 3 models, BERT, and then the Roberta, which is the optimized BERT, which is a slightly better performance. And then we look at FinBERT, which is again a BERT model which was fine-tuned further and finance-related information. Again, many of these things you can always fine-tune them, because the general idea is the BERT models or these other models, they capture the general language patterns, but the general language patterns might be slightly different in finance-related context. So the way you can do is you can just fine-tune it further. In some ways, you can think of adjusting the weight slightly compared to what the base model does. So that's what we use, and what we find is Roberta achieves the best performance, 90.44% accuracy. So we feel confident among these 3 models, and there's not as much variation in terms of the 3 tasks that we have. These 3 are the tasks that where we train it, whether it contains price information, input or output, and prices. On those 3 things, typically we get 90 to 96%. There's not as much variation in the models in terms of the predictive power, and we use it. So we use Roberta. I don't think it makes that much difference which one we use, because all of them are doing a reasonable job. And once we have it, now we take Roberta and then go back to all the earnings conference calls from 2007 to 2021, use the model to predict each of this inflation exposure for the firm. So now with the label data, once we have it, now we have the weights, we can actually do it for all the earnings calls that are there. and this gives us a firm level measure of inflation exposure in that particular earnings call. So, time varying measure of that. So, the measure that we do is a standard measure. We look at input, the number of sentences with up, input prices are up, minus the number of sentences with input price down, divided by total sentences. We also look at separately output prices, input price, etc. The data I mentioned, the standard data sets, IBIS, CRISP, and other things that we use. We were on 102,000 earnings calls. This is how it looks in terms of the data. Again, in some ways not that surprising. The ones which are more shaded, are the ones where there's more of discussion. And you can think of, for example, chemical, non-durables, manufacturing, etc. There's more discussion of inflation-related pressures as compared to healthcare and business equipment. So, and it varies over time. The shades, as you can see, like some of them are higher, some of them are lower in some years. Again, this is the correlation, as I said, is around 0.77. This is just like eyeballing in terms of how the PPI and CPI looks like. The blue one is our inflation exposure measure, and the dotted lines are either CPI or PPI. And what we look at is, as expected, when the inflation PPI or CPI has gone up year on year, we measure that. Again, our textual measure also goes up. Again, it might be because the CEOs by themselves start talking about it, or it might be because oil price went up, so chemical industry or airlines, the analysts might start asking about what are your plans, do you have pricing power to pass on this cost. And for both reasons that might happen, and that's what we see, the patterns are similar. This at least gives us confidence that we are capturing, or measure is capturing something. Again, there's much more discussion of price up discussion than price down discussion. It's around 3 times more discussion in price ups versus price down. So, they seem to be talking about more about that. Okay. So, now what do? We have a firm level exposure measure, and at least given some confidence broadly that it does capture some information related to input and output prices, and it varies over time. So, now we want to look at the stock market reaction of the firms to this information. The broad idea is, if this is not related to inflation, or this is not relevant for the firm, or this is already captured by some other information, quantitative or qualitative information, which is already there shouldn't be that much reaction, and even the reaction shouldn't vary with our measure. So, that is why we do just a simple event study around these earnings calls. And our specification is, we look at firm fixed effects, we look at industry times time fixed effects, because many times this might change based on the industry. As we can see, like the inflationary pressures would be different for different industries, and they vary with time. That's why we wanted to look at this industry times time, and then we look at firm fixed effects, double cluster standard errors at the firm and year quarter level. So, the main results, again, not in some ways not that surprising, is that in all the specifications, depending on what we put in the regressions, that an increase in inflationary exposure leads to lower stock market response, a negative stock market reaction. One standard deviation increase leads to around 31.1 basis points. So, the market seems to react to this information. One thing I just want to mention is, we look at this uncertainty and sentiment overall. This is based on reading the entire transcript and trying to figure out how many sentences which have this is simple keyword based approach, the Lugren-McDonald kind of approach we take here, and see if it's instead capturing about uncertainty in the which is there in the text, and then sentiment, overall sentiment of the transcript. So, after controlling for that and also controlling for earnings surprises, the market reaction might be because of what's revealed in the earnings, not necessarily because of inflation exposure. So, at least we control for those things, and again, controls can never be perfect, but to the extent that we control for all those things, we still find the inflation exposure leads to a strong negative market reaction. We look at the information in the next 30 days, next 60 days, next 90 days, it's typically negative, and if we look at over the next 3 months, it significantly negative. It appears that the market doesn't completely price this information immediately. It might take some time for the market to recognize the value of this information. That's why we have some kind of negative drift. Here we break it down into, since we have the information about input prices and output prices, think of a 2 by 2, up and down input and output. We look at this, and again this line up with again our intuition. When the input prices go up, more negative reaction. when the input prices go down, more positive reaction, output prices go up, positive reaction, output prices go down, negative reaction. Again, this is completely consistent with what we would expect based on the firm's margins and firm's profitability. Then we look at pricing power. Part of the reason is in case the firms, even if the prices go up, they're able to mark up and pass it on to their consumers, it shouldn't really matter for the firm. So that's why we wanted to look at pricing power measures. We have experimented with a couple of them looking at the CompuStat measures, but finally we looked at just the discussion of this in the earnings call itself. We look at the number of, this is a textual pricing power measure. If anyone has better measure ideas, I'm all open. I think it would be interesting to look at other measures. We look at output, the number of times they talk about output price going up divided by the number of ones with input price going up. We think of it as the pricing power. That is in the same sentence, if they talk about, we had, for example, the oil price went up, our feed costs have gone up, but we are able to pass on the cost to our consumers by increasing the prices. In the same sentence, they might talk about it. That's why we want to look at that. And basically what we find is that at least those firms that are saying that they're able to pass on maybe, or which have more pricing power, the market reaction is mitigated or positive here. So that at least seems to indicate that again validates some of what we have done so far. Why do investors react negatively? Again, this is I think of the validation. We look at over the next time periods, we look at the cost of goods sold, the material cost, the wages from CompuStat for these firms. Again, they line up as you would expect. Higher inflation exposure means higher costs for the firms as measured by COGS, materials, wages, etc. So again, this seems to indicate that our measure is picking up inflation exposure at the firm level. We look at the event study as I mentioned around CPI release. The idea is that when CPI comes in, there's more inflation than what was anticipated based on the consensus estimates. There might be more negative reaction for these firms because they're more exposed to inflation. And again, we do the standard kind of event study here with the event fixed effect for each of the CPI release from, we look at from 2012 to 2019 if I remember right. So what we find is the immediate price reaction for those firms for CPI release days is more negative. And if we break it down into the salient days, that is more than 2% and the less than 2%. And again, in the sample period, it's not too many days. We plan to extend the data. Now, at least we should have a lot more every month. We're getting higher than 2%. So I think we are going to have a lot more when we extend to 2022. We didn't do that because of earnings calls. We didn't have all the information, and then CompuStat data and others, we don't have information. That's why we stopped in 2021 second quarter. Our results should get only stronger if we extend it. What we find is if it's salient, there's much more negative reaction. It's economically also it's larger. And some of the, like again, the significance is on the borderline, partly because again, we don't have too many events in the sample period where it's salient more than 2%. Okay. So the contribution of this paper is threefold. In some ways, one, we develop a novel text-based measure of inflation exposure at the firm level. And this involved a lot of labeling and also not only using the pre-trained model, but further fine-tuning the model on all this labeled data. That's the one which is a time-consuming process that also requires GPU and that also requires some effort to do that. That's what we have done, and this can be applied in other contexts also. Again, I have applied in a couple of other papers, and this is applicable to many, many other contexts. And the second is we try to link between the inflation exposure at the firm level and its stock returns, and we find a result consistent with in our expectations that firms with more higher inflation exposure have more negative stock returns. Markets don't seem to completely incorporate it. There's a negative drift, and or 3 months the negative reaction manifests. And finally, we also show the correlation between textual inflation measure and inflation index. And in some ways, we don't push it as much, but this can also be a nowcasting kind of thing, since as information comes in, one can construct this kind of measure, and that also might be an alternate measure of inflation, at least at the firm level, industry level, one can do that, which can supplement the standard measures of inflation that we have in the literature. So thank you. I look forward to Mike's comments on this paper.
Right. Thank you, Sudhir. Right on time. And now we have Michael Weisbach from Ohio State who will provide a discussion.
Oh, thank you. Great. Thank you so much. Yeah. And this works? In principle, yes, that's right.
Yes. Okay, thank you so much, and thank you for having me. And I want to commend all of you for staying till the very end. It's been a long couple of days and very interesting presentations. And so one of the things I decided when I saw the schedule was that, first of all, I would keep my discussion really short because I know you guys will. I've been in the long conferences and know at the end. And then secondly, I would. I figured by now you would be sick of Bert and Finbert and all of the machine. So I will not talk about any of that. Okay, I will talk about what I think the paper means. And so by the way, one more thing. When I was writing those papers with Per and Ulf a long time ago, I used to visit Stockholm all the time, and I was very happy to get the invitation, and I got to meet all the new generation of faculty, which is very nice to get to know all of you. So. Okay, so what the paper does is it uses machine learning to evaluate firms' earnings call transcripts. It measures words using, measures price changing using words, obviously. It comes with a text-based measure of inflation, and I put that in quotes for reasons you'll see in a minute. And then it documents the extent to which this inflation affects stock returns, and they compare input versus output price changes, and they also look at market power and how market power affects it. And basically, that's what you just heard about for the last half hour. Okay, so I thought maybe I'd take a step back and think about what we really mean by inflation. Okay, and what inflation usually means is the aggregate level of prices. And maybe we're just semantics here, but this is textual analysis, so that is semantics. I always thought of inflation as a monetary phenomenon, and so it turns out this was invented by Milton Friedman. And what Milton Friedman said is that inflation is always and everywhere a monetary phenomenon in the sense that it is and can be produced only by a more rapid increase in the quantity of money than in output. And so the most famous example, of course, is in the 1920s when Germany decided it needed more money, so it printed lots and lots of marks, and pretty soon the marks were fairly worthless. And so that's just kind of what inflation is, and that's the way it's taught in a standard course. And so again, I just want to point out the example that was given was when costs increased for one input to production. What that is an increase in the relative prices of goods and not the absolute level of prices. And what inflation refers to is not the relative prices, but the absolute level of prices. And so that's just, I think, an important distinction here. Now, another thing that the paper could be measuring is it could be measuring cost and demand shocks. So in other words, the real prices, what that does is they change all the time because of changes in costs and demands. And I thought the example that was given in the presentation was a good example of a change in the cost structure. And so rather than a macroeconomic and a monetary phenomenon, these tend to be firm-specific or industry-specific in nature, okay? And the one thing I want to emphasize is that you have cost and demand shocks that occur in inflationary times. You also have costs increasing in deflationary times. So these are logically two separate things, right? And so the cost and demand shocks are just conceptually a very different thing from inflation, okay? And I guess the question I had when I read the paper and I thought about it was whether the paper measures inflation or measures other kinds of shocks, okay? And what the paper focuses on is cross-firm differences in the amount that they're affected by these things. And well, if it was inflation, macroeconomists, when I took macro way back when, basically the gist of lots of literature was that inflation has real effects through nominal contracting, right? Because when contracts are written in nominal terms, and then all of a sudden inflation happens, and all of a sudden everything gets out of whack. And I don't think that what we're discovering now has to do with nominal terms. But if all contracting were in fact in real terms, then everything would be neutral and inflation would have no real effects, right? And so I don't think the paper's picking up nominal contracting, but it might be. I don't know. So another issue that came up to me that was a little bit funny, and this was actually recognized in the presentation more than the paper, is that it's had the peculiar thing, the peculiar experiment of measuring inflation in a time when there actually wasn't inflation, right? So it's sort of weird because, you know, to the sense that all this was all the authors could do, because that's when the conference calls were and that's when the data were. And I'm very happy to hear that they're going to extend it to the current, you know, the last 6 months when all this, you know, especially since, you know, if you're sort of looking at when people were talking about inflation, I mean, people didn't talk about inflation until like 2 years ago, right? And then all of a sudden, everyone talks about it all the time right now. So certainly using more modern data would be really interesting. I mean, the average inflation over the sample period was 2% or something like that. And so if you're, I mean, ideally, you know, I would try, if it were possible, you should go back to the 70s or sometime, or even other countries where they have inflation. Really, I think that would be a really kind of a more interesting period to do your analysis. Another thing has to do with the influence of market power. And the paper says something like, when firms have market power, they should be affected differently by inflation. And again, I tried to think back to my Econ 101 days when I used to teach this. And okay, so basically, the standard formula, I tried to avoid formulas, but I have a couple. So the standard formula for competitive industry is price equals marginal cost, right? So if cost goes up, then the price goes up proportionally, right? And so I don't understand what you said when you say that when competitive firms can't, you know, pass on the cost, because that's exactly what they do, right? But then a monopolist, what a monopolist does is, if you remember from Micro 101, it says that the price cost margin, proportional price cost margin, is equal to 1 over the elasticity of demand. And the thing about elasticity of demand that economists like so much is that they are unit free, right? So that basically if the price level doubles, the elasticity of demand doesn't change. So this thing, right-hand side, is unaffected by inflation. And so therefore the left-hand side should be unaffected by inflation. So basically the price cost margin should be unaffected by inflation. So basically, both in competitive industries and monopolistic industries, at least in the basic economic model, neither one of them should be affected by inflation, again, unless there is some kind of nominal contracting, which is sort of well beyond the scope of Econ 101. So, and so anyway, in the terms of keeping it short, that's it. Overall, it's a very interesting way to study firms' price and cost, and I kind of think that's what the paper is actually doing. And again, one thing I didn't put down on the slides, if you think about the results on you know, the stock price reaction and all of that, basically they are much more in line with the price cost interpretation, right? Because you know, when output prices go up and costs don't change, well, this is like good news for firms, right? But that's not inflation, that's just demand increasing, right? And when costs go up and demand doesn't change, well, that's bad news for firms. But if inflation was just raising, what it would do is raise all prices proportionally, and the firms effectively, their real profits wouldn't be affected. But it is, I think, it's an interesting approach to studying firms' pricing. I mean, I do like the idea of using textual analysis to understanding firms' cost structures. And again, I think it's just perhaps it's just semantics, but I think the paper is concerned, I would almost change the title, concerns firm-specific costs and demands rather than inflation, and that's it. So again, I tried to keep it short. So what? So I'll sit down, and I guess I'll sit in front.
Sudhir, would you like to take a minute or two to respond?
Yeah, it probably is a bit of semantics in terms of what we call. Initially, we were thinking about developing something at the aggregate level, and then we went to the firm level. So maybe we need to change it to something about firms' costs and demands, but it won't be as catchy. So, so we'll look into that. Yeah. Thank you.
All right, so now I will open up the floor for anybody who has questions for Sudhir. So let's start up front.
Oh, sure.
Just one quick suggestion on the time frame. So maybe what you could do is like, you know, just go full machine learning and then try to fit the text measure of inflation to firms observables, right? And if you have firms observables, you can just go back in time and then just project it backwards. So you would use like supervised learning to predict your text measure of inflation based on firm characteristics, and then you can do those things to study it like back in time through the 70s and through hypers of inflation, with the obvious caveat that it's a model fit and it depends on the quality.
Yeah, probably we can try something like that, because we are more focused on the text one, but we haven't thought about the most we can go to is till 95 with SEC filings. We can do that, but we can, yeah, I need to think about it. Maybe we can do that.
So related to actually my point of the aggregation example, right? So what basically, if you aggregate across firms, you get the aggregate number, right? Now you have only public firms, so publicly available accounting statement. What you can do, you can try to form some form of sub-aggregation, subgroups, and see whether there is, for example, is this inflation at the aggregate level somehow related to the public firms one, or where is private sector really, private non-listed sector really driving it, or maybe geographic diversification about inflation at local level, this kind of stuff would be very interesting to construct, right?
Sure, yeah, we can see if we can do that. Yeah.
My question is more about the training sample selection. I know all the difficulties in building training samples because I've tried to do the same and it's challenging. At the same time, I think it's very important to take that step very seriously, you know, and whenever there is no random sampling to select the sample, there is bias introduced in the estimation, and there are nowadays some machine learning methods that rely on Bayesian updating to try and correct for that bias. And also there's a huge literature on greater disagreement, which is also very important to kind of like take a bit more seriously. And in the spirit of a lot of the stuff on language changes, if your whole sample belongs to 1 year, if I understood, or like a short
sample
period.
is 2007 to 2021.
No, the training sample.
The training sample where we labeled sentences was in 2021.
That's the thing. So
Yeah.
if there is language changes, like your entire measure relies to how reliable that training sample is. And so I just suggest that you put a bit more like thought or explanation on that part.
Sure, that's always there, I think, and there's a large literature and rater bias, and I think technically we should actually, the people who rate and the people who write this, we need to separate it out and do that. But my understanding of many of the papers I've done is this, the earnings conference call is not as much change in some of this information. So I'm not as concerned, and again, we always have to trade off between how much time it takes from 28,000 sentences, which require, then we have to go to like 500,000 sentences. The trade-off between those two things. But we'll look into that, and maybe there might be other ways of doing it better.
So my question is related to the heterogeneous response of the firms to the input price changes. So essentially, this will be affected by how much inventory the firm have in the beginning period. Because if they have inventory stock, when the input price changes, if it increases, they can stop purchasing the materials and just use whatever that is have from their inventory. So there will also be an interaction there, similar to how the market power affected the effect of the output price changes and how that affect the firm. But this is more of the endogenous choice, and it will be interesting.
Yeah, sure. That would be interesting to look at. The recent Target example is a classic case where they write down their inventory. There's a big negative. So we can look at their inventory.
So I guess I will ask a question here. So at the end of your talk, you talked about the price or the returns responses to higher than usual expected inflation. I'm curious then whether the effect is sort of asymmetric or if it's symmetric. Right? That is, if I were to look at announcements of CPI that comes in lower than expected, that your results on the cars basically flip.
Yeah, that's what we find. Any questions?
All right, seeing no other questions, I'll turn
Thank you for all the comments.
to Ye to close the session.
Thanks so much. Thank you so much for attending this conference. And then I'll give a really quick conclusion. So AI is super important. And then thank you so much for sharing your insights here. Hopefully you enjoy the conference and also have a sweet memory in Stockholm. We see each other in the future. Thanks.